Thanks for having me. It's good to be back again this year. As Amy said, I run Tribeca's Nuclear Energy Opportunity Fund. So we'll just fast forward here. We launched the fund in 2018. After looking through the sector, we've returned, it's a wholesale Aussie unit trust, returned just over 400% net of fees and performance, most of that being in 2020 and 2021 as the sector awoke from a pretty ordinary decade of bear market. When we look at the sector, as I said, we break it up into a bunch of different sort of jurisdictions and things just to report to investors. The investor letter tends to go out a little bit wider, so we don't talk too many stocks in the letter, but we try to give our investors the best understanding of where we're at. We basically get to the nuclear theme via decarbonisation. We started obviously looking at that as a thematic that hit the world, as well as the resource sector, and you've seen that play through in critical minerals, in lithium, in the push to renewable energy and things like that. What we sort of quickly realised was that if you're decarbonising via electrification, it's sort of a waste of time to have the electricity as carbon, full of carbon. So you also need to decarbonise the grid, and that's how we sort of got onto nuclear. When we look at the thematic of decarbonisation, we sort of looked at the universe as to where we sit, the supply-demand fundamentals, the future demand coming through the sector, the current state of the market. And as you can see, on a number of different metrics in which we look at, uranium ranks very, very highly up there, and we'll get into that as to why and how. Now, as well as decarbonisation, we've had a push from governments. It started on a decarbonisation push, and since the war in Ukraine, that's moved to a theme of energy security. Obviously, as many countries have found, when you're reliant on Russia or the movement of hydrocarbons, and that gets disrupted, it causes you some problems. So we've seen here a bunch of commercial decisions have been sort of taken out of the hands of global utilities, and the governments have taken direction on that. And I mean, this is just a snapshot. If we need to actually update this slide because there's a lot more things happening. But basically you're seeing there's 33 odd nations in the world currently using nuclear power. Australia obviously not one of those. But almost all of those governments have made a decision to keep their existing reactors running, to look at extending the life of those reactors. They're also looking to build gigawatt scale capacity, so new capacity. And there's a lot of investment going on in the future technology of small modular reactors, which we'll get into later in the presentation. The one great thing about modelling uranium demand is that you've got the World Nuclear Association that does it for you every 2 years. And it's fairly easy to model compared to other commodities because you've got very long decisions happening. So tomorrow for a nuclear fuel buy at a utility is 2 or 3 years' time because it takes 18 to 24 months from uranium to get from mine mouth to reactor cores. So they're looking through cycles. The fuel buyers, obviously, first goal is don't run out of fuel. And the price of the uranium is actually not that relevant to what's going on. So this is the latest WNA report, and you can see here they do 3 demand scenarios, all of which are plausible. The reference scenario is the most likely to happen. But when you look at the little columns below, that's the supply response that the WNA have visibility on. So anybody that's spent any time in any commodity knows that keeping existing supply on is really hard. Bringing back idle capacity is hard. Developing mines on time and on budget is difficult. And planned and prospective mines are nice to have, but often don't come when you want them and the price you want them. So there's a lot of things that need to go right here just to meet the demand on the lower scenario from the WNA. Remember, this is the World Nuclear Association looking at everything, not an analyst, an oil analyst at a bank who's picked up uranium. So we place a lot of emphasis and quality on this data. So a lot of things have got to go right for the lower scenario. Interestingly, the WNA say that the gap between those columns to get to the reference in the upper is called unspecified supply. Now, I've looked at the list of planned and prospective projects that the WNA think are going to come to market, and I've got question marks in a few of those. There's a hell of a lot of drilling that needs to happen. There's a hell of a lot of bringing exploration projects into development to meet that unspecified supply, to pick up a demand that's not really going to change. So this is where the thesis is interesting. There's already a deficit, a primary mine supply deficit. There's already a deficit before we even look at future demand. And we've had that deficit for a decade. So, as I said, there's 33 odd countries using nuclear power. For the last decade, they've relied on secondary supply and inventory drawdown to meet that deficit. We're now in the middle of the largest reactor build program we've seen in decades. So we're going back to the 70s, 80s and 90s for the last time we had this many. 61 odd reactors. You can see on the chart there on the left there, that's going to require 30 odd million pounds a year of uranium. So new supply of uranium. Currently we're consuming about 185 million pounds, and in the next 5 or 6 years another 30 is going to be added. So you can see there, that's basically going to require for ex-China to find another MacArthur River mine, and for China to find more than their Namibian Husab mine, just to fulfill the new reactors. So if no other reactors are being built, we still have a primary mine supply deficit from the existing fleet, which governments have turned. So we've had a natural decline go back to flat because governments have said keep them on, keep them running and extend them. And we've got that new demand coming in. And here we are at $70 odd with not much, no wall of supply that everybody's expecting. So this is where the thesis differs, and I'm spending a bit of time on this because I'm going to bring some new slides in a bit later. There's a lot of geopolitical risk as well. So, as you can see, Kazakhstan is almost half of the supply of the world's uranium. And as a result of what's going on in Russia, Ukraine, the Kazakhs' main route to bring uranium to markets via the port of St. Petersburg is out of action for most of the world. They're looking at a trans-Caspian route. They've moved some material through, and they're looking to move some more. But that's not an easy route. It's got to cross a number of countries, some that have got some civil problems. And again, I touched on the nuclear fuel cycle. So it's not just the spot uranium price, which we'll look at in a second, that we can focus on here. We've got a fuel cycle where there's a cost of moving that uranium from U3O8 to a fabricated fuel rod. And all of those prices are at decade or more highs. So it's saying to you that this is not speculators. It's not people coming in and hoovering up physical pounds. There's actually real business going on in the real market, in the actual market. I can't go and buy your Richmond, for example, as a fund manager. That's the very tightly controlled market by utilities and participants. And here we come to the spot price. I mean, I don't like talking to the spot price because it's a very inefficient market. I've spent many years trading physical commodities. I can tell you most physical commodity markets are efficient. Uranium's probably top of the list. There's a very small number of players, and often it can move, $1 or $2 or $3 on no trading. As we've seen the last few days, it's being offered down a little bit. And obviously then the Sprott Physical Uranium Trust has brought a lot of excitement into the market. It's got this facility that's, when it's trading to a premium to NAV, it issues shares, uses that cash to go in and hoover pounds. What we can see here is, yes, at the beginning, and with those lines on that chart, there was a lot of activity in the spot. But more recently, the price of uranium has held up with spot being noticeably absent. We had a little flurry in September, so even that is showing you that market's small and it's tight, and the participants don't think it's going to go down. More importantly, the bottom chart here is long-term contracting. So the uranium sector trades like iron ore did in the early 2000s. On long-term contracts. 95 to 98% of the business that happens in the market is long-term contracts. A utility contracting with a producer or a development project 5, 10, 15 years out. Most of that price is confidential, and most of the terms are confidential, so it's hard to get transparency on it, and you need to rely on market insiders to give you an idea of that. But what we can see here is year to date already, we're at decade highs in contracting. However, even at £150 million, they're not contracting anywhere near the amount they're consuming. So we're not at replacement rate value. And remember, we've got a decade of contracting below replacement rate. So in other words, they're getting future pounds at a lower rate than what they're burning, and had that reliance on secondary and inventory draw. Now, this is a new chart because people keep saying to me after September, it's done enough. It's gone to $70. It's overvalued. The sector hasn't, the sector's reached a point of maturity. And so I just want to compare it to the lithium story, where we're really happy talking about a 1,500% rally in the price of lithium, or spodumene here, that I've used. And as you can see, some eye-watering returns in some of these lithium names. And I've purposely picked some producers and some developers and those building. And here we are with a comparable universe of, again, Cameco being a producer, NextGen Development Access, Paladin, Boss building, and Deep Yellow development. We've done 300% in the uranium price since 2017 lows. Last cycle we did 1,800%. So whilst past is not an indicator of the future, I truly believe that this sector has further to go, because $60 was a medium-term incentive price, but we've seen cost inflation and everything. $75, $80, where is that incentive price to bring this wall of supply on? And we'll touch on a bit later, price is not the only thing that we need to get right, especially with uranium. There's a bunch of other things that make development assets hard. And again, this is what I touched on a little bit earlier. The lithium market started relatively in balance because the demand was future and hadn't been built. We saw obviously a big uptake in demand as gigafactories got built, not just in China, but now in ex-China. And now we're sort of in balance, which is why you're seeing the lithium price roll over a little bit. There's still going to be a future deficit, assuming all of these gigafactories get built. And the point I want to make here is that, the lithium story, battery electric vehicle, it is affected by short-term economic cycles. Is a global recession going to put lower battery electric vehicle sales, which causes a gigafactory to think twice about whether they make that investment? Is, for example, 2/3 of European gigafactories risk delay or cancellation because of economic problems? As I said, flip that down to the uranium demand and supply here. We've had a decade of deficit. So we've gone into this cycle from a decade of deficit with the demand already in place. So it's already been built and the decisions are being made to keep it on, as well as decisions to increase that. So not only do we, as I said, we've had a decade of inventory draw, but the decisions in nuclear are longer term because governments are making them. So, they're turning around saying that utility, that reactor you're going to turn off in 2030, we want you to apply for a 10 or 15-year life extension on that. So it's longer term, it's looking through cycles. And you've got China who are building these things like crazy. As I said here, China's the new king of nuclear power. Not quite, but it's getting there, and especially with their ambitions, they're massive. Small modular reactors, they're not coming, it's technology that's never going to come to market. They are coming, and in the bottom right there you can see that the World Nuclear Association had its first attempt this year to model some small modular reactor demand. And, on the high case scenario, that's some big numbers, 60, 70 million pounds. That's 2 or 3 MacArthur Rivers of Cameco just for that. There's I can't read exactly, but there's a huge amount of modular reactor designs being considered. And there's a lot of governments who are putting money into it. And, it's US, Canada, UK, Korea, China, Europe. They're all looking at this technology. And governments are pushing it. They want it through. Now, the first wave is existing technology. So there's nothing new in it. It's just a smaller version of what we already have. The second wave, when you start looking at Bill Gates, TerraPower, and the fast breeder reactors, they've got a little bit more work to do and they'll be needed because they solve some spent fuel problems as well. But they will be a little bit longer, but the first wave, they're being built, they will come, and they've got government support. Again, we just touched on this. We look at transportation to decarbonise and realise that electricity also needs to be decarbonised, and if you bring the transportation into electricity, that's a bigger burden there. It's low carbon, it's zero carbon power. Once it's built, it just produces 24/7 electricity, and you can see some stats in China and the US. And, it's a footprint here. More than half of the world's uranium is in situ leach and situ recovery. So it's a very small environmental footprint, as opposed to other hydrocarbons. And when you look at the density of that, one uranium pellet, it's like the size of the top of your pinky here, does, what a ton of coal does. So, even with that small environmental footprint, you don't need a lot of it. You could see there, gigawatt of electricity, 1,000 megawatts. It's 3 kilograms of uranium compared to 10,000 tons of coal. So it's an extraordinarily efficient commodity to generate electricity from. And this is, again, you've seen some comments from Elon Musk. We talk about crypto, it's very energy intensive. Musk is making some comments about nuclear power whilst smoking something there. But also you're seeing data centers and AI and as I said, crypto miners all looking at their electricity now, saying, I need 24/7 baseload electricity, and I need to decarbonise because I'm using a hell of a lot of it to keep us all getting emails and what have you. And then just the land footprint as well, a gigawatt scale nuclear power plants, a 2 square mile radius of the plant, of the reactor area. You need 11 million solar panels and almost 1,000 wind turbines. And the nuclear stays on throughout the evening. We've seen obviously some big high profile people come and support the nuclear thesis. Bill Gates obviously pushing his SMR technology, Sam Altman of ChatGPT pushing his, and a lot of sort of pushed behind the technology. Cameco Brookfield, again, this is the deal where sort of Cameco and Brookfield Renewable Partners entered into a deal to acquire Westinghouse Electric. Everybody looked at the Cameco angle of this, and it's a phenomenal deal for them because it vertically integrates them. And when you also then look at their missing piece of enrichment, they have that via GLE and Silex. But to me, the Brookfield angle was the thing that most people missed. This is Brookfield Renewable Partners, not Brookfield Infrastructure, Renewable Partners. It's the largest energy transition investor in the world with 125 gigawatts of projects, who have just given a big green tick to nuclear power and nuclear services. And that's caused a lot of that ESG and energy transition sector to really take pause and say, we need to have a look at this. When you talk to the Cameco investor relations team, they said their biggest inbound since that announcement has been energy transition, ESG funds and investors globally saying, we need the 101. We need to understand why Brookfield Renewable have said this is an acceptable form of a project to fit their very tight mandate. And then, of course, the follow-on, obviously, is energy funds who say, if Brookfield Renewable are looking at it, maybe we need to take a closer look as well. And this is what I'm saying here, so we're sitting here in that little round thing. Everybody says, we're at $60, we're at $70, there's going to be a wall of supply. But there are so many things that need to happen for any mining project, and it's on steroids when it comes to uranium, especially around permitting, especially around community, and especially around First Nations. So you as well as solving all the other problems, trying to bring a project to market of what's the capex required, what's the appetite to get that money from the equity capital markets or debt capital markets, what's the management team like? We've had more than a decade of no capital in the sector and everybody on life support. So is the management team of the quality to be able to put a drill bit in where they want to do it and not burning shareholder money? Can they bring a project to development? And then, as well, as we've seen everywhere in the world, is there the equipment and the labour availability to bring these projects? So already, as we've gone up in the last few months, we've seen a handful of projects that I had in my models as coming to market now or in the next 6 months have been delayed. And these are the low-hanging fruit of restart projects or greenfield. So what's going to happen when we get to that unspecified supply of the WNA? Hopefully, the sector's so big and so well capitalised that the majors are then moving in again. But so there's a lot that needs to be done in the sector, and price is not the only solve. So just bear that in mind as people telling it's overvalued and there's going to be all this supply coming in. And the maths doesn't lie. So we've got to come back to the mathematics of it all. We need NextGen's Arrow to come to market, 22 million pounds a year over life of mine. We need Boss Energy, we need Paladin, we need all of these restarts to come to the market, and even then we're still short of pounds. We need another big project. We need Kazatomprom to do what they say they're going to do in 2025. And just as an aside to that, almost all of those expansion pounds that they announced when they upgraded their mine guidance recently are going to Russia and China, not to the West. So any utility sitting there thinking that they've got some Kazakh pounds coming out in the next 3 or 4 years are asleep at the wheel there. So it comes down to that fundamental scenario every single time. We've had a decade of underinvestment. We've had a decade of inventory draw and reliance on secondary supply. And we're getting to a point, and we've had a backflip on demand where we've gone from, flat to down to now up, and utilities expecting just magically these pounds are going to appear. I'll leave it there. I don't know. Are we doing questions, or are we or moving on? If there are any questions, I think I've got 2 minutes and 40 seconds on my speaking clock here.
So, if you're a junior explorer, would you recommend they go and look for uranium? Because we know how hard it is. It's not like 2006, where if you're an explorer, you're tracking the uranium price in your share price. It takes a long time to bring these things on, and there's a lot of waiting to be developed projects sitting there. So is it a good avenue for explorers to follow?
Yeah, look, last cycle we had 500 listed opportunities that had uranium in their name, and a lot of them probably never even found any uranium. I think in 2017, when we looked at this, there was 20-odd investable opportunities. That's now 50-odd. We have a whole last cycle of projects that were progressing, and had we not had the rug pulled from underneath us as a result of the Fukushima tsunami, those would be a lot more developed. So there's some very good last cycle projects that should come back to the market. They're in private hands or in a long list of from companies. I think it's probably a little bit early to be staking sort of moose pasture and saying, I'm going to throw a drill bit out here and hope, but it'll certainly come. But it's probably second or third wave.
Thanks.
You said there were 61 under construction new reactors. That's actually under construction. What about the pipeline?
Yeah, well, the pipeline's massive because you think China's going to 70 gigawatts. They plan to go to 150, and they'd like to go to 300. So just in China alone, 300 gigawatts is about 150 million pounds of uranium demand per year. So just on what they want to do, it's massive. When you see the IAEA come out recently and with their decarbonisation plan of all energy, they're saying a doubling of nuclear capacity, which is just a phenomenal amount. I think it's 26 reactors a year to be built to fulfil that. So there's 13 countries building new reactors. 3 of those are brand new to nuclear. The other 10 are existing countries. But you've also then got a whole bunch of countries signing up for small modular reactor technologies as well. So the pipeline is massive. And as I said, that's probably the upper demand scenario of the WNA to say all of these come into market. And I tell you what, the sector's got to do a lot of work to keep up with that.
I'm just wondering, it's all very good to have so many more nuclear power stations come on. What are they planning to do with the waste products afterward? What's the plan for that, and how to store it safely?
So the sector's been dealing with spent fuel for 60 years without incident. And the reason I'm choosing to use the word spent fuel is because there's still an energy value in that. And in the 70s and 80s and 90s, there was actually a lot of fuel reprocessing that happened. So that fuel came out of reactors, went back into reprocessing. What happened was we saw Russia, Uzbekistan, Kazakhstan come in as very cheap supply of uranium, and the price of uranium went to $8 at a time where a lot of grids were deregulating. So suddenly, they're private utilities as opposed to government run, and making economic decisions. It was cheaper to buy it at $8 than it was to reprocess. So France reprocesses a lot of their spent fuel. Canada have a reactor that can take a lot of spent fuel. But the main reason it's not buried deep underground is because it still has a value. As I said, when you see what GLE, Silex and Cameco will do with that laser enrichment, that's reprocessing depleted tails from the Department of Energy back into a product and go into reactors. And then when you get that second wave of small modular reactors, these fast breeder reactors, most of those will take spent fuel. We very easily throw in spent fuel from civilian reactors with low and medium radioactivity waste that comes from hospitals and X-rays and things like that. We throw that all in and say, wow, there's a lot of it. When you look at what actually comes from utilities, nuclear reactors, like in the US, for example, it would fit into a football field 3 metres high. So the volume of spent fuel is not actually a lot. I think that's probably all we have time for, don't we? Yep. Okay, thanks very much for your time. It's been a pleasure.